Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, November 1st, 2024. Last month's bad weather along the East Coast did more damage than wrecking homes and displacing millions of people. It also closed down local economies, which, along with the work stoppage by Boeing workers, contributed to an unusual jobs report for the nation during September. And I've included a link to that jobs report, which is what we're looking at right now. Instead of adding the 100,000 net new jobs expected last month, only 12,000 jobs are created. However, the unemployment rate was unchanged at 4.1%, since idled workers, whether voluntary or involuntary, are not classified as being unemployed by that formula. Normally, an anomalous data point that can easily be explained would not get much attention on Wall Street. But with the general election only 4 days away and the next monetary policy decision by the Fed due in a week, Wall Street's nerves are frayed. The collective stress in the financial markets is evidenced in the behavior of the stock market this month. The S&P 500 index lost 1% in October after hitting a new intraday all-time high on October 17th. And that's when the latest round of quarterly earnings reports started coming out, which thus far have been solid but not exceptional. So here's a one-year chart of the S&P 500. And by the way, it was almost pretty close to exactly a year ago that this rally started, and that's when the economic data started improving, especially with respect to inflation. So you look way over here on the left, S&P 500 a year ago on this day was at 42.37. You can see right here it's at 57.58. And that's a nice looking chart. But if you do look out here to the right, and now we say look at the last 6 months, you can see right over here the peak a couple weeks ago and then the subsequent. It's a small decline, not much, but nevertheless a bit of a decline. What has been exceptional is the rapid rise in the yield on the 10-year Treasury note over the past 2 months. Since bottoming out near 3.6% 6 weeks ago, it opened above 4.3% this morning. That is close to where it was a year ago before improving inflation data ignited a stock market rally when the Fed signaled its readiness to start cutting interest rates this year. So here's the one-year chart of the 10-year Treasury note. You see again a year ago, just when the stock market rally began, it was also when interest rates really started coming down fast. Then during the first quarter of this year, they rose when the inflation data kind of leveled off, and then been coming down steadily ever since. But then again, here we see the big bump here. So, although interest rates have gone full circle during the past year, the stock market has soared. The S&P 500 has gained 36% over the past 12 months, while the NASDAQ composite is up 40%. So again, let's go back to this chart of the S&P 500. Look at the past year, which I mentioned is a 36% gain. NASDAQ, because it includes all of the so-called Magnificent Seven mega cap tech stocks that dominate that index, it's done a little better. But nevertheless, those are pretty remarkable returns for 1 year periods. Now, those conflicting data points, and by that I mean yield on the 10-year Treasury note almost coming all the way back to where it was a year ago. Meanwhile, S&P 500 and NASDAQ up 36 to 40%. That begs the question, are lower interest rates really necessary for the economy to flourish? If so, then stocks should be tanking right now because interest rates are going up, or at least the yield on the 10-year Treasury note is. But since they are not, that suggests the economy is holding up on its own without the assistance of central bank stimulus. Nevertheless, just about everyone on Wall Street is anticipating the Fed to reduce its policy rate by 25 basis points when it meets next week, and by another 25 basis points in December. That would put it back to where it was at the end of 2022 in a range of 4.25% to 4.5%. Now, if that sounds high to you, consider the average Fed fund rate over the past 60 years is 4.6%. Now, I've included a link here to the chart that the St. Louis Fed keeps of the Fed funds rate, and here's a chart going all the way back to 1954. Now, that number, that average of 4.6%, includes these years during the early 1980s when the Fed was getting stagflation under control, but it also includes the artificially, the ZIRP, the zero interest rate policy, earlier this decade in response to the coronavirus pandemic. The reality is that interest rates are close to where they are during normal times. Meanwhile, the unemployment rate is well below its long-term average, near 5%. So here's a chart of that going back to post-World War II, 1946. And that average works out to almost exactly 5%. The economy may not be perfect, but it is in better shape than a lot of people seem to think it is. And that's this week's PF Update, and I look forward to talking to you in another week. Thank you.